Chapter 2. Entering Wall Street. I called Luke Keller. I told him who I was and what I wanted. Next day he sent me some papers to sign and advised me that as soon as I returned them with a deposit, I would have an account with his brokerage firm. When I received his notice, something happened to me. Suddenly, I began to feel that I was becoming part of the financial scene. I cannot describe Wall Street because I have never been there physically, but even its name had an almost mystical attraction for me. Here, everything was going to be serious and different. I now considered my Canadian induction period as pure crazy gambling that I would never repeat. As I studied the long grey columns of stock market quotations in the New York papers, I felt I was about to enter a new and successful period in my life. This was not like the wildcat Canadian market with its quick tip-offs on gold strikes and uranium fields. This was responsible business, the street of bank presidents and great industrial combines, and I prepared to enter it with proper reverence. I intended to make a much more cautious and mature approach to the stock market. I added up my assets to see what I had to work with. I had started in the Canadian market with $11,000, my original brilliant investment of $3,000 and profit of $8,000. This had been reduced by $5,200 in the 14 months of my Canadian operation. All I had left of the brilliant money was $5,800. This did not seem like enough money with which to approach Wall Street, so I decided to add to it. From the savings of my show business activities, I raised my stake to $10,000. It was a good round figure, and I deposited this sum with the broker. Then one day I decided to start trading. I rang Luke Keller and nonchalantly, trying to be the old financial hand, simply asked him what was good. I realized now this inquiry was more suitable for a butcher, but Mr. Keller was equal to it. He suggested several safe stocks. He also gave me the fundamental reasons why these stocks were safe. While I did not understand, I listened intently to such explanations as dividend 19 increase, stock splits, improved earning. Now this to me was the highest professional advice. This man earned his living on Wall Street, so obviously he knew. Besides, he only suggested. He emphasized that the decision was up to me. This made me feel important and in command. When one or two of the stocks he gave me rose a few points almost immediately, I had no doubt of the excellence of the information I was receiving and my natural ability as a stock market operator to act on it. What I did not know was that I was practically smack in the middle of the biggest bull market the world had ever seen, and it was quite difficult, unless you were extremely unlucky, not to show a little paper profit from time to time. Here are 3 typical consecutive deals I concluded in the early part of 1954 deals, which convinced me I was a natural in Wall Street. In this table, as in all the following tables in this book, I have included commissions and taxes. 200 Columbia pictures bought at $20, $4,050.00, sold at $22, $4,513.42. Profit $463.4 to 200 North American Aviation bought at $24, $4,904.26, sold at $26, $5,309.89. Profit $405.63 100 Kimberly Clark bought at $53, $5,390.35, sold at $59, $5,854.68. Profit $464.33 total. Profit $1,333.38. You will note that each of these transactions netted me just over $400. It was not a large sum, but 3 profits in a row amounting to $1,333.38 in just a few weeks made me feel that these were smooth, simple operations and I was in control. The feeling that I was operating with a profit in Wall Street, allied to a natural awe of the place, made me feel foolishly happy. I felt I was losing my Canadian amateur status and becoming a member of an inner circle. I did not realize my method had not improved, that I was simply using more pompous words to cover it. For instance, I no longer considered the broker's advice as tips, but as information. As far as I was concerned, I had given up listening to tips and instead was receiving authentic news based on valid economic evidence. The boat sailed happily along. Here are some of my transactions during April and May 1954. Bought sold National Container 1112 Tricontinental Warrants 56 Alice Chalmers 5054 Bucyrus Airy 2426 General Dynamics 4347 Mesta Machine 3234 Universal Pictures 1922 Profits, profits, profits. My confidence was at its height. This was clearly not Canada. Here everything I touched turned to gold. By the end of May, my $10,000 had grown to $14,600. Occasional setbacks did not bother me. I regarded them as slight, inevitable delays in the upward climb towards prosperity. Besides, whenever a trade was successful, I praised myself. When I lost, I blamed it on the broker. I continued to trade constantly. I telephoned my broker sometimes 20 times a day. If I did not conduct at least one transaction a day, I did not feel I was fulfilling my role in the market. If I saw a new stock, I wanted to have it. I reached out for fresh stocks like a child for new toys. These transactions in which I was involved in Wall Street around July 1954 will show the energy I expended for very small returns. 200 American Broadcasting Paramount bought 100 at 16, $1,709.38. 100 at 17, $1,772.50. Sold at 17, $3,523.06. Profit $41.18. Entering Wall Street, how I made $20 lakh in the stock market. 100 New York Central bought at 21, $2,175.75. Sold at 22, $2,213.70. Profit $37.95. 100 General Refractories bought at 24, $2,502.38. Sold at 24, $2,442.97. Loss $59.41. 100 American Airlines bought at 14, $1,494.75. Sold at 15, $1,476.92. Loss $17.83. Total profit $79.13. Total loss $77.24. My net profit on these transactions was $1.89. The only person who was happy was my broker. According to the New York Stock Exchange rules, his commission on these 10 transactions amounted to $236.65. Incidentally, my $1.89 profit did not include the price of my telephone calls. In spite of this, only one thing really bothered me. Half the words my broker used concerning the stock market I did not understand. I did not like to show my ignorance, so I decided to read up on the subject. In addition to the financial columns in the New York daily papers, I began to read books about the stock market so I could talk on his level. Slowly, I became acquainted with a series of new words and was always trying to use them. I was fascinated by words like earnings, dividends, capitalization. I learned that per share earnings means the company's net profit divided by the number of shares outstanding, and that listed securities are those stocks that are quoted on the New York and American stock exchanges. I labored over definitions of stocks, bonds, assets, profits, yields. There was plenty to read, because there are hundreds of books published about the stock market. More has been written about the stock market, for instance, than about many cultural subjects. At this time, I studied books like R. C. Effinger ABC of Investing Dice and Eatman the Stock Market B. E. Schultz the Securities Market and How It Works Leo Barnes Your Investments H. M. Gartley Profit in the Stock Market Curtis Dahl Consistent Profits in the Stock Market E. J. Mann. You can make money in the stock market. Armed with my new vocabulary and what seemed to me my growing knowledge, I became more ambitious. I felt the time had come to find another brilliant. After all, somewhere there must be a big, sound Wall Street stock that could do as well for me as what I now considered a little penny stock. I started to subscribe to stock market services such as Moody's, Fitch, and Standard & Poor's. They gave me what seemed to me magnificent information, except that I did not understand any of it. Some of the passages read like this: promised expansion in consumer expenditures for durable goods, non-durables and services, plus a fairly pronounced improvement in productive efficiency, provide the base for rather good earnings and dividend improvement for companies whose earnings will reflect the favorable nature of these conditions. We expect continued irregularity to continue temporarily, under the guise of which this new status of the market's preference will be implemented. They were dignified, impressive. They told me everything I wanted to know except which stock was going up like brilliant. As I read them, however, curiosity overcame me. I wanted to see what other stock market services were saying. I saw in the papers that, as in Canada, for $1 I could have a 4-week trial subscription to certain services. Soon I found myself a trial subscriber of almost every service that advertised. I collected clippings from everywhere: daily papers, financial columns. Entering Wall Street, how I made $20 lakh in the stock market book jackets. Whenever I saw a new financial service advertised, I immediately put my dollar in the mail. As the releases arrived, I found to my great surprise that they often contradicted each other. Frequently, a stock that on service recommended for buying, another recommended for selling. I also found that the recommendations were almost always non-committal. They used terms like buy on reactions or should be bought on dips. But none of them told me what I should consider a reaction or a dip. I overlooked all this and read on avidly, hoping to uncover the secret of the stock that can only rise. One day, an advisory service which prided itself on giving information only 5 or 6 times a year published a very glossy release, nearly a whole book, examining Emerson Radio. It compared this company favorably with the mighty RCA. It went deeply into Emerson's capitalization, sales volume, profits before tax, profits after tax, per share earnings, comparative price earnings ratios. I did not understand all of this, but I was very impressed by these erudite words and the analytical comparisons. They proved that Emerson stock, which was selling around 12, should be worth 30 to 35, comparable to the price of RCA at that time. Naturally, I bought Emerson. I paid 12, which seemed a nice low bargain price for a stock which the glossy booklet assured me was worth 35. What happened? This surefire stock began to drift downwards. Puzzled, baffled, I sold it. Now, I am certain that the serious Wall Street analyst who prepared this glossy booklet had nothing but the highest intentions. But I must record in the interest of truth that by the end of 1956, the stock was down to 5. About that time, I heard a saying which has been passed from mouth to mouth for generations in Wall Street, but to me was new. You cannot go broke taking a profit. I was much impressed by this and I was burning to put it into operation. This is how I did it. One of the market leaders early in February 1955 was Kaiser Aluminum. On my broker's recommendation, I bought 100 shares at 63, paying $6,378.84 for the stock. It went up steadily, and at 75 I sold it. I received $7,453.29, which gave me a profit of $1,074.45 in less than 1 month. Hoping for another quick profit, I switched into 100 Boeing at 83. I paid $8,343.30 for these shares. The stock almost immediately began to drop. 4 days later, I sold at 79 for $7,940.05. My loss on the Boeing transaction was $403.25. Trying to make up for the loss, I then bought Magma Copper in the first week of April. It was selling at 89. I paid $9,018.98 for 100 shares. No sooner did I buy than it started to drop. 2 weeks later, I sold it at 84 for $8,002.18. This gave me a loss of $1,016.80. By this time, Kaiser Aluminum, which I had jumped out of in the first week of March, had moved up to 82. An advisory service was recommending it, so I switched back to it, buying 100 shares at that price. I paid $8,243.20. 5 minutes later, it started to slide. Not wanting to risk a further loss, I sold at 81 and received $8,127.59. This meant that for 5 minutes of trading, I lost $115.61, including commissions. On the first Kaiser deal, I had made a profit of $1,074.45. The losses sustained by jumping in and out of the other stocks were $1.535.66. So the whole circular transaction, which began with Kaiser and ended with Kaiser, gave me a net loss of $461.21. If I had stuck with Kaiser from my original purchase at 63 until my ultimate sale at 81, I would have had a profit of $1,748.75 instead of the loss of $461.21. Here is another case. From November 1954 to March 1955, I was constantly jumping in and out of a stock called Rainier, which in an 8-month period went from approximately 50 to 100. These were my transactions in Rainier, 100 shares at a time. November-December 1954 bought at 53, $5,340.30, sold at 58, $5,779.99. Profit $439.69. February, March 1955 bought at 63, $6,428.89, sold at 71, $7,116.13. Profit $687.24. Entering Wall Street. How I made $20 lakh in the stock market. 25 March 1955 bought at 72, $7,242.20, sold at 74, $7,353.39. Profit $111.19. Total profit $1,238.12. The profit I made on this series of trades amounted to $1,238.12. Then the old loss pattern repeated itself. In April 1955, I switched into Manti Sugar. I bought 1,000 shares at 8%, paying $8,508.80. Immediately afterwards, it started a downward slide, and I sold out at the varying prices of 7, 7, and 7. I received a total of $7,465.70, giving me a loss of $1,043.10. This left me with a net profit of $195.02 on the combined Rainier monthly operation. However, if I had held my original November purchase of Rainier without constantly trying to take a profit and sold it in April at 80, I would have had a profit of $2,612.48 instead of $195.02. What did all this mean? I did not appreciate it at the time, but it was a classic refutation of "you cannot go broke taking a profit." Of course you can. Another stock market saying that began to fascinate me was "buy cheap, sell dear." This sounded even better. But where could I buy something cheap? As I searched for a bargain, I discovered the over-the-counter market, the market of unlisted securities. I knew from my books that in order to get its stock listed and traded on the stock exchanges, a company has to observe very stringent financial regulations. I had read that this did not apply to over-the-counter stocks. This market, therefore, seemed to me the perfect place to find a bargain. I naively believed that because these stocks were not listed, few people knew about them and I could buy them cheap. I hurriedly subscribed to a monthly booklet called Over-the-Counter Securities Review and started hunting. I searched eagerly among the thousands and thousands of names for the bargains that seemed to be offered. I bought stocks like Pacific Airmotive, Collins Radio, Gulf Sulfur, Doman Helicopter, Kenamital, Take Oil Corporation, and some of the more obscure ones. What I did not know was that when I came to offer them for sale, some of these stocks stuck to my fingers like tar. I found it very difficult getting rid of them and rarely at anything like the price I paid for them. Why? Because there was no rigid price discipline as there is for the listed securities. There were no specialists professionals to assure a continuous and orderly market. There were no reports where one could see at what price a transaction took place. There were only the bid and ask prices. These, I discovered, were often very far apart. When I wanted to sell at 42, which was the quoted ask price, I only found a buyer at 38, the quoted bid price. I sometimes ended up at 40, but that was by no means certain. When I stumbled into the over-the-counter market, all this was unknown to me. Fortunately, I quickly came to realize that this is a specialized field and is only lucrative for experts who really know something about the affairs of a particular company. I decided to give it up and returned my attention to listed securities. All this time, I never once questioned the truth of any Wall Street rumors. I had no way of knowing that they are just as ill-founded and dangerous as rumors in the Canadian or other markets. What I believed to be solid information, piped straight from Wall Street, had the most sensational lure for me. Here are two typical cases that show the sort of information I gobbled up and acted upon. One day, a strong rumor floated into the market that Baldwin Hamilton, a firm of railroad equipment manufacturers, had received an order to construct an atomic train. Wall Street acted on this at once. The stock shot up from 12 to over 20. By the time I heard this startling information, the stock had risen to what later turned out to be its peak. I bought 200 shares at 24. The purchase price was $4,954.50. I held the stock for 2 weeks and watched with utter unbelief as it slipped slowly back to 19. By then even I realized that something was wrong, and I sold it for a loss of $1,160.38. However, I had done the very best thing in my bewilderment. I could have fared much worse with that stock since it later went down to a low of 12. Another time my broker called me and said, "Sterling Precision will go to 40. before the end of the year. The stock was quoted at 8. He gave me the reason. The company is buying up many more small prosperous companies and will grow into a giant in no time. He added that this was first-hand information. To me that was sufficient. Why not? A Wall Street broker, who I thought could not possibly be wrong, had favored me with this authentic news. I could not give my buying order quickly enough. I entering Wall Street how I made $20 lakh in the stock market decided, in view of the source of my information, to plunge big on this one. I bought 1000 sterling precision at 77.8 paying $8,023.10. I sat back happily to watch it rocket toward 40. Far from rocketing to 40, it began to waver. Slowly it slid downwards. When it looked as though it would fall below 7, something had obviously gone wrong. So I sold the stock at 71.8 for $6,967.45. This piece of news showed me a loss of $1,055.65 in a few days. The stock subsequently touched a low of 41, but these losses were more than offset by the great pride I felt in being part of Wall Street, and I constantly searched for new approaches. One day, reading the Wall Street Journal, I saw a column reporting stock transactions by officers and directors of listed companies. When I looked into this further, I found out that, to prevent manipulations, the Securities and Exchange Commission required that officers and directors report whenever they bought or sold stocks of their own company. Now, that was something. Here was a way for me to know what the real insiders were doing. All I had to do was to follow them. If they were buying, I would buy. If they were selling, I would sell. I tried this approach, but it did not work. By the time I found out about the insiders' transactions, it was always too late. Besides, I often found that insiders were human too. Like other investors, they often bought too late or sold too soon. I made another discovery. They might know all about their company, but they did not know about the attitude of the market in which their stock was sold. Through these and other experiences, however, certain conclusions began to emerge. As a baby repeatedly hearing the same words starts to learn them, so did I slowly start, through my trading experiences, to discern the outlines of some rules that I could apply. They were: 1. I should not follow advisory services. They are not infallible, either in Canada or on Wall Street. 2. I should be cautious with brokers' advice. They can be wrong. 3. I should ignore Wall Street sayings, no matter how ancient and revered. 4. I should not trade over the counter, only in listed stocks where there is always a buyer when I want to sell. 5. I should not listen to rumors, no matter how well founded they may appear. 6. The fundamental approach worked better for me than gambling. I should study it. I wrote out these rules for myself and decided to act accordingly. I went over my brokerage statements, and it was then that I discovered a transaction that gave me a seventh rule and led to the events that immediately followed. I discovered that I owned a stock and did not know it. The stock was Virginian Railway, and I had bought 100 shares in August 1954 at 29 for $3,004.88. I had bought it and forgotten it, simply because I was too busy on the telephone jumping in and out of dozens of stocks, sometimes making as little as 75 cents. Other times frantically calling up about a sliding stock, trying to sell it before it dropped any lower. Virginian Railway had never given me a moment's anxiety, so I left it alone. It was like a good child that sat playing quietly in the corner while I worried and fretted about the behavior of a dozen bad children. Now that I saw its name after having held it for 11 months, I hardly recognized it. It had been so quiet. It had gone completely out of my mind. I rushed to my stock tables. It was standing at 43. This forgotten, calm, dividend-paying stock had been slowly rising. I sold it and received $4,308.56. Without any effort on my part or even any anxiety, it had made me $1,303.68. It also made me dimly aware of what was to become my rule number 7. I should rather hold on to one rising stock for a longer period than juggle with a dozen stocks for a short period at a time. But which stock will rise? How to find it by myself? I decided to have a look at Virginian Railway. What had caused its steady rise while other stocks were jumping about? I asked my broker for information. He told me that the company paid a good dividend and had a fine earnings record. Its financial position was excellent. Now I knew the reason for the steady rise. It was a fundamental reason. This convinced me of the tightness of my fundamental approach. I made up my mind to refine this approach. I read, studied, analyzed. I set out to find the ideal stock. I thought that if I really studied the company reports, I could find out all about a stock and decide whether it was a good investment. I began to learn all about balance sheets and income accounts. Words like assets, liabilities, capitalization, and write-offs became commonplace in my vocabulary. For months, I puzzled over these problems. Night after night, for hours entering Wall Street, how I made $20 lakh in the stock market, 29 after my daily dealings. I pored over the statements of hundreds of companies. I compared their assets, their liabilities, their profit margins, their price-earnings ratios. I thumbed through lists like stocks with top quality rating stocks, the experts like stocks selling below book value, stocks with strong cash position, stocks that have never cut their dividend time and again. However, I was confronted with the same problem. When things looked perfect on paper, when balance sheets seemed right, the prospects bright, the stock market never acted accordingly. For instance, when I carefully compared the financial position of some dozen textile companies and after much study decided that the balance sheets clearly indicated that American Viscose and Stevens were the best choices, it was very puzzling to me why another stock called Textron advanced in price while my two selections did not. I found this pattern repeatedly in other industry groups. Baffled and a little disconcerted, I wondered whether it would not be wiser to adopt the judgment of a higher authority about the merits of a company. I asked my broker whether there was such an authority. He recommended a widely used, serious, very reliable monthly service, which gives the vital data on several thousand stocks, the nature of their business, their price ranges for at least 20 years, their dividend payments, their financial structure, and their per share annual earnings. It also rates each stock according to relative degrees of safety and value. It fascinated me to see how this was done. High-grade stocks whose dividend payments are considered relatively sure are rated A safest, A safe, a sound investment, merit stocks that usually pay dividends, BBB best of group, BB good, be fair. I went over my brokerage statements and it was then that I discovered a transaction that gave me a seventh rule and led to the events that immediately followed. I discovered that I owned a stock and did not know it. The stock was Virginian Railway and I had bought 100 shares in August 1954 at 29 for $3,004.88. I had bought it and forgotten it, simply because I was too busy on the telephone jumping in and out of dozens of stocks, sometimes making as little as 75 cents, other times frantically calling up about a sliding stock, trying to sell it before it dropped any lower. Virginian Railway had never given me a moment's anxiety, so I left it alone. It was like a good child that sat playing quietly in the corner while I worried and fretted about the behavior of a dozen bad children. Now that I saw its name after having held it for 11 months, I hardly recognized it. It had been so quiet. It had gone completely out of my mind. I rushed to my stock tables. It was standing at 43. This forgotten, calm, dividend-paying stock had been slowly rising. I sold it and received $4,308.56. Without any effort on my part or even any anxiety, it had made me $1,303.68. It also made me dimly aware of what was to become my rule number 7. I should rather hold on to one rising stock for a longer period than juggle with a dozen stocks for a short period at a time. But which stock will rise? How to find it by myself? I decided to have a look at Virginian Railway. What had caused its steady rise while other stocks were jumping about? I asked my broker for information. He told me that the company paid a good dividend and had a fine earnings record. Its financial position was excellent. Now I knew the reason for the steady rise. It was a fundamental reason. This convinced me of the tightness of my fundamental approach. I made up my mind to refine this approach. I read, studied, analyzed. I set out to find the ideal stock. I thought that if I really studied the company reports, I could find out all about a stock and decide whether it was a good investment. I began to learn all about balance sheets and income accounts. Words like assets, liabilities, capitalization, and write-offs became commonplace in my vocabulary. For months, I puzzled over these problems. Night after night, for hours entering Wall Street, how I made $20 lakh in the stock market, 29 after my daily dealings. I pored over the statements of hundreds of companies. I compared their assets, their liabilities, their profit margins, their price-earnings ratios. I thumbed through lists like stocks with top quality rating stocks, the experts like stocks selling below book value, stocks with strong cash position, stocks that have never cut their dividend time and again. However, I was confronted with the same problem. When things looked perfect on paper, when balance sheets seemed right, the prospects bright, the stock market never acted accordingly. For instance, when I carefully compared the financial position of some dozen textile companies and after much study decided that the balance sheets clearly indicated that American Viscose and Stevens were the best choices, it was very puzzling to me why another stock called Textron advanced in price while my two selections did not. I found this pattern repeatedly in other industry groups. Baffled and a little disconcerted, I wondered whether it would not be wiser to adopt the judgment of a higher authority about the merits of a company. I asked my broker whether there was such an authority. He recommended a widely used, serious, very reliable monthly service, which gives the vital data on several thousand stocks, the nature of their business, their price ranges for at least 20 years, their dividend payments, their financial structure, and their per share annual earnings. It also rates each stock according to relative degrees of safety and value. It fascinated me to see how this was done. High-grade stocks whose dividend payments are considered relatively sure are rated A safest, A safe, a sound investment, merit stocks that usually pay dividends, BBB best of group, BB good, be fair.